Thank you all for joining us for our first ever financial summit. I'm so excited that we can bring together some of the brightest minds in the financial field, from Edward Jones and Moneta, to put this summit on for you. As the leading disability services provider in Missouri, Easterseals Midwest is here to support families and individuals at every step of their lives, from early intervention after diagnosis to employment for teens, and to supporting adults to live independently in their own homes. As the CEO of Easterseals and someone who has been in the disability service industry for more than 40 years, one of the questions I get asked repeatedly by parents and caregivers is, how can I set my loved one up for a financially stable future? Right now in Missouri, there are more than 60,000 people with a developmental disability living with a caregiver over the age of 60. It's difficult to think about, but as a parent or caregiver, we won't always be here for our loved ones, and preparing for that day is critically important. That's why we brought together these experts to answer your questions about financial planning for people with disabilities. I hope you walk away from this presentation with a deeper understanding of how you can do that, and a sense of relief that you have the necessary resources moving forward. Now, we are honored to hear some special remarks from a true disability champion, both at home and in Washington, D.C. Missouri's own United States Senator Eric Schmidt.
Just want to welcome everybody to this financial planning seminar event hosted by Easterseals. Easterseals is a great organization. I've worked with them for a very, very long time and always trying to get ideas from them on things that we can take forward, whether it's when I was in the state Senate or in statewide office or now in the United States Senate. So we're working on some things that are important, but I think for this seminar, it's important to highlight how important it is to plan for the future. And individuals with disabilities are no different than typical folks about planning. And there's a few great ways to go do that, one of which is the ABLE accounts, and was pleased to be a part of this, passing it. And then my son Stephen, who has a lot of challenges, was actually account number 1 back in, I think, 2018-ish. So very proud of that, but that's available for everybody in the state. It's a great way to save in a tax-advantaged way for the long-term needs that you or a loved one are going to have. So check it out. It's a trusted source to go do that and provides a lot of opportunities.
Thank you, Wendy and Senator Schmidt. I'm Shelby Nickel, and I'll be your moderator. Before introducing our 2 financial experts, I'd like to share just a little bit about myself. I'm the founder of Muriel Consulting, a consulting and recruiting company focused exclusively on financial advisor practice expansion. I'm also a member of Easterseals Advisory Board and the Women's Giving Collective, which is a philanthropic group of women who support Easterseals' mission. I'm also a founding board member of the St. Louis-based Women Leaders in Finance. I've spent most of my 25-year career in financial services, and I'm also a mom to 2 neurodiverse kids. I am thrilled to introduce my 2 friends and our 2 expert panelists for this evening. Our first expert is Sarah Vagey. Sarah is a certified financial planner and financial advisor with Edward Jones. She's also a chartered special needs consultant. She crafts financial strategies for her clients that address both present challenges and future aspirations. Sarah's passion for disability inclusion drives her commitment to guiding clients through life's transitions with confidence and security. She and her family have benefited also from the services Easterseals Midwest provides for nearly 10 years. Thank you for joining us, Sarah.
Thank you, Shelby. I'm so excited to be here.
Our second expert is Tasha Borglum with Moneta. Tasha is a partner at Moneta and certified financial planner who specializes in tailoring financial plans to maximize a family's potential of meeting short and long-term goals. In her spare time, Tasha loves traveling and spending time with her husband and 2 boys, one of whom has high needs. She understands the unique challenges as well as the unique joy that comes with raising and caring for a special needs child.
Thanks, Shelby, and thank you all for being here tonight.
So for this evening's summit, we're giving Sarah and Tasha the opportunity to answer questions that were submitted by you prior to this evening. One final note before we begin. I want to remind everyone that the information you're receiving here tonight is for informational purposes only, and it's not intended to be personal financial advice. Please consult a financial advisor about you and your family's specific needs. So with that, we're going to start with a question that both Tasha and Sarah say they get asked often. What is the difference between financial planning for a family impacted by a disability and those who don't face a disability? Sarah, do you want to start us off?
Absolutely, Shelby. Each family is unique, and as such, each family's financial plan is unique to them, with or without a disability. The first step is to determine each family's specific needs and goals. Does the child currently qualify and receive government benefits? If the answer is yes, then the financial plan will need to be structured to protect those benefits while providing for the benefit of the child. This is typically done through a special needs trust. If the answer is no, they do not qualify or receive government benefits, then we'll discuss the goals for the family in a different way. Perhaps the child will financially provide for themselves to some extent, but not at the lifestyle or living standard the parents desire. What is the gap between what the child can provide for themselves and what the parents desire? For both situations, we'll look at income needs for the child beyond their parents' lifetimes and determine the appropriate path forward. That could be through insurance, annuities, or other investments, depending on the family's unique situation. We'll also look to protect the family by ensuring they have the appropriate insurance, as well as estate planning documents in place so that the child is taken care of, even if something unexpected occurs.
Thank you, Sarah. Tasha, what would you add?
Sarah is spot on when she says that whether disability is a factor or not, every family's financial planning needs are very different, and there is no single answer for this question. Some of the planning issues are actually very similar. All families need to budget. All families with minor children should have legal documents in place naming guardians for those children. We all want to leave what assets we have to our children as efficiently as we can. I think that the main difference lies in how those matters are tailored for an individual family. One family might have to budget more for medical expenses, medical equipment, or long-term care than another family. A legal guardian for a minor child could turn into a guardianship or a conservatorship for an adult with a disability. Like Sarah said, a family might need to create a special needs trust or enable account for their child instead of a lifetime trust for their child. There are other examples as well, but in general, I think that the length of time that these matters continue into adulthood and navigating the public benefits system are the two things that I see as the key differences when working with a family impacted by disability.
Thank you both. We're now going to go to some of the submitted questions. So our first is from Becky from Joplin, and she asked, I am already saving for my son's future through workplace retirement. What should I plan to leave behind, and how much is enough?
I'll take this one, Shelby. It's wonderful that you are already thinking ahead to provide for your son when you are no longer here. How much to leave behind for him depends on so many factors. Does he now, or will he receive government benefits in the future? Is he able to provide for himself financially at any level? What kind of lifestyle or living standard do you want to provide for him? Once you've got an idea of your preferred future for him, you can work with your financial professional to determine if you are on track and if the amount you are saving will be sufficient. They can help you navigate protecting your assets for his benefit so that all of your hard work and saving for his future is safeguarded. Additionally, they can help make sure that you list the appropriate beneficiary for your retirement plan. And beyond the finances and estate planning needs, it's important to talk with whoever will be there for your child after you're gone to help them understand how to support your child. This could be the specific guardian you've named or the family member or friend that your child trusts and feels most comfortable with.
A quick follow-up to that, what suggestions do you have for organizing important medical and financial information for a family should something happen to a caregiver? Tasha?
I have a binder at home that includes contact information for my son's entire medical team and First Steps therapists. I have had conversations with the guardians named in my estate plans for my children. But in addition, I have created an informational letter that outlines our family's wishes and vision for our son in the short and long term, and some tendencies or information that just might be helpful to know about him in the day-to-day. My son is not on any medications, but if yours is, that would obviously be an incredibly important piece of information to document. I keep this information along with our family's estate plan and a list of our financial assets and life insurance policies all together, which is crucial for both of my minor children. Our guardians know where this information is kept within our home, and I have a note on my calendar to update it once per year. Admittedly, it was a lot of work to put all of this information together, but it gives me peace of mind knowing that in a crisis situation, the individuals that we have named to step in for my husband and myself would have something to help make the transition a little easier for everyone.
To add to that, many families I work with have not only a digital copy, but also a dedicated fireproof box containing their estate planning documents, birth certificates, list of medical professionals and therapists, medical history and records, and specific medical instructions. In addition to these documents, the letter of intent that Tasha mentioned can be extremely helpful. This letter shares your child's likes, dislikes, and hopes for the future, including living arrangements, career, and lifestyle. Showing these documents and location to your child if appropriate, and their future guardian or trusted person, along with an in-person conversation to explain them, will help ease the transition during a challenging time.
Our next question comes from Kelly in Baldwin. I've heard I can deduct expenses for my daughter who has autism on my income taxes. Is that true? And if so, what can I deduct?
With the caveat that I am not a CPA, I can answer this question generally and would encourage anyone with specific questions about your individual situation to speak directly to your CPA or tax provider. If your daughter is a minor and you provide at least half of her support, then you can claim her as a dependent on your tax return, which qualifies you for a tax exemption. Once your daughter turns 19, you likely can continue to claim her as a dependent if she meets the definition of permanent and total disability, you provide at least half of her support, and she cannot be claimed as a dependent on anyone else's return. There are other criteria that can qualify or disqualify a situation, so again, it's really important to speak to a tax professional if you have specific questions. If you ultimately meet the requirements to claim your daughter as a dependent, that will open up your eligibility to deduct many of the medical expenses that you incur on her behalf. This could include items such as therapies, home modifications, specialized medical devices, in-home health services, and many others. Keep in mind, though, that only out-of-pocket expenses that exceed 7.5% of your adjusted gross income are deductible. This also assumes that you have enough in total eligible deductions to itemize versus taking the standard deduction. Keep good records of any expenses you incur that aren't reimbursed by insurance or a tax-advantaged plan like a health savings account, and submit those expenses to your tax accountant. He or she can determine how much of your out-of-pocket expenses will be deductible, and as I already mentioned, can provide more specific guidance on your individual situation.
We have a similar question from Susanna in Kansas City, who asked, I have an in-home caregiver we have hired for my son. Am I liable for injuries they may get on the job? Is there special insurance I should have?
This is a really good question, and it's smart to be thinking about it. It really depends on who the employer is. Did you hire this person and do you pay them yourself, or are they employed by an agency or private company? If the latter, the agency or company likely has policies in place. It's important for you to understand what they'll cover and what they won't. Regardless, for many families, an umbrella liability insurance policy can be a smart investment. These types of policies protect your family's assets in the event of an injury or loss of income to others due to an event on your property and are typically very affordable. Your financial professional can help you assess if it's needed and the appropriate amount.
I'll add that a call to the agency and your insurance provider to confirm and fully understand your exposure is always a good practice. If you hired your caregiver directly and on your own, then you should speak with your insurance agent about how to minimize the financial risk of your employee getting injured or being involved in an accident while on the job. Having the right kind of liability and workers' compensation coverages in place for your in-home caregiver will not only protect your financial assets in the event of a claim, but it will also help protect your future income and income earning ability.
Thank you both. Our next question comes from Mike in Springfield. He says, I have a special needs trust in place. Is that enough? What else should I be thinking about? Sarah, will you start us off?
Sure. The Special Needs Trust is a wonderful starting place. However, many clients are surprised that there is more to do beyond the Special Needs Trust. Other legal documents to consider are powers of attorney, healthcare directives, guardian if a minor, and guardianship considerations if an adult. Your legal professional can draft these for you. It is essential for you to review the beneficiary designations of all of your family's assets, such as IRAs, 401ks, life insurance, including your home, and make sure they are updated with the appropriate name. Also, it's critical to communicate with other loved ones, such as grandparents. Grandparents often want to help with the financial needs of a person with disabilities. They need to make sure to list the Special Needs Trust for any bequests intended for your child. Beyond legal documents, it's important to think about questions like, what are the child's preferred future living arrangements? Do they want to live independently or with others? How will their life change if something were to happen to you? What are your child's stressors in life, and what strategies help her cope? Writing down things like her favorite foods, activities, and places to go will help those who will care for her. These discussions should happen on an ongoing basis, as answers may change as your child grows and matures.
We have a follow-up question that I'll direct to Tasha. Can an ABLE account be used in conjunction with a Special Needs Trust?
Yes, an individual can have both an ABLE account and a Special Needs Trust concurrently. The ABLE account can have up to $100,000 in it without impacting means-tested governmental benefit programs. ABLE accounts can serve as a recipient vehicle for things like small monetary gifts or unspent work earnings, among other things. It's also a great tool to have available for budgeting shortfalls that exist after exhausting monthly governmental benefit checks and qualified Special Needs Trust distributions.
Thank you, Tasha. Our next question is on the same topic and comes from John, who lives in St. Louis. He asks, can I make my child's Special Needs Trust the beneficiary of my life insurance policy?
Yes, depending on your unique situation, this could be the recommended approach so that the child does not receive assets directly, which could impact their government benefits. It allows your child's supplemental needs to be taken care of while also providing income and estate tax advantages. It's important for the trustee of the Special Needs Trust to understand how to distribute funds to your child and what is considered a qualified expense, so that they don't inadvertently impact government benefits received by the child.
I'd like to add that the type of life insurance policy you choose is incredibly important, as you want to ensure that the death benefit is available to fund the trust at your passing. Some types of life insurance, such as term insurance, only last a defined number of years. If you live past that term, the death benefit may not be there to fund the trust as intended. A financial professional can help you with the right plan and policy design to appropriately execute this planning strategy.
That leads us into a question from Steve, who is from Joplin. He asked, does my disabled son qualify for life insurance? Let's start with you, Tasha.
Thanks for sending us that question, Steve. It depends on your son's underlying condition, diagnosis, and how impacted he is from it. It can be a lengthy process, as the insurance company will review his medical history and records, which could result in approval, coverage at more expensive rates, or denial. Before deciding to go through that process, though, it's important to consider the why behind the effort. Life insurance is intended to protect against the financial consequences and hardships that can occur as a result of one's death. If your son is not earning income and he has no dependents that financially rely on him, then obtaining life insurance coverage may not make sense, and the dollars that would have otherwise been used for premiums can be utilized elsewhere. A financial professional can help you decide the best path forward for your unique circumstances.
I'll add that life insurance on an individual is commonly used to supplement the income they provide to their family or business. If you are looking to provide for your disabled son after your death, life insurance on yourself can be an effective tool. You'll need to name the appropriate beneficiary depending on your situation. Your financial professional can help you determine the amount needed and the type that will provide the benefits you're looking for.
We have another follow-up to that. Can a child with disability receive an inheritance or be named a direct beneficiary of someone's assets? And if so, does receiving those assets impact their government benefits? Tasha, we'll go to you.
There is a difference between can and should. Yes, a child with a disability can be named as a direct beneficiary of someone's assets. However, that may not be the best planning strategy since owning too many personal assets or having too much income can impact eligibility for public benefits. There is additional complication if the child is a minor. Leaving an inheritance to a vehicle like a special needs trust can allow for an individual to inherit assets in a manner that doesn't impact his or her eligibility for programs like SSI and Medicaid. This also ensures that a third party is managing the assets for the benefit of the child who may or may not possess the skills to do so independently.
Next, we have a question from Laqueta in Colombia. She asks, do I need to get a power of attorney for my son? What about guardianship? Sarah, will you start this one?
Sure, Shelby. This is another great question. A recurring theme you've heard today is that it depends on your situation and your child's abilities. In general, for all families, when a child reaches the age of majority, which is age 18 in Missouri, it is important to consider a power of attorney.
Tasha, can you share your take on this?
The specific documents you need in place for your adult son depends on his capacity. If he has the capacity to understand what financial powers of attorney and healthcare directives are, then having executed documents outlining his wishes and decision makers may be appropriate. These documents are important for all legal adults, not just adults with disabilities. If your son has been determined to be partially or totally incapacitated by his physician, then you will need to work through the court system to pursue appointment as legal guardian of his person and conservator of his estate so you can make financial and healthcare decisions on his behalf. Working with an attorney that understands your family and the overall financial and legal goals is best practice. When planning with my clients, we review together what legal documents may be prudent and when they should be in place, such as age of majority. Your financial planner can help coordinate with your legal professional to guide you through this process based on your family's circumstances.
Laqueta also had a follow-up. She said, I've heard of people disinheriting their kids with a disability. Is there a benefit for my son if I do that?
I would recommend that anyone considering this strategy consult an attorney, as it isn't as simple as one may think. While it may be well-intentioned, disinheriting a disabled child can have unintended consequences. I heard a story once of a parent leaving all their assets to their child who did not have a disability, thinking that child would help their disabled sibling financially if ever needed. The inheritor child ended up getting divorced, assets got divided, and some of the inheritance actually went to the former spouse. Had the inheritance been divided between both children, with the disabled child's portion perhaps going into a properly structured special needs trust, the family might have been able to retain more assets for the sole benefit of their children. This example highlights how good intent can go awry. As Sarah and I have outlined today, a properly structured special needs trust aligned to a financial plan can be established to enhance your child's quality of life while maintaining his or her eligibility for governmental benefits. An ABLE account could potentially be used for smaller estates as well.
Thank you. Our final question of this evening comes from Ashley in St. Charles. She says, my son has Down syndrome. How can I support him without jeopardizing current or future governmental benefits? Sarah, we'll turn to you first.
Great. A legal professional should be consulted, though a special needs trust may be appropriate to support him without jeopardizing his government benefits. A special needs trust helps individuals who receive government benefits by providing for their supplemental needs beyond what their benefits will cover. Money from this trust cannot generally be distributed directly to the individual, but rather to a third party for payment of goods and services on behalf of the individual. Life insurance on yourself or a grandparent may be an appropriate option if you plan to fund the special needs trust during your lifetime. Guardians of an individual with disability can serve as their own trustee, or they can appoint a family member or corporate trustee for the special needs trust.
This is such a great question. Support can mean so many things. There are some strategies outside the Special Needs Trust and ABLE account tools we discussed earlier that might be worth considering. If your son is interested and has the potential to hold a part-time job for a few hours a week, that could help give him a sense of responsibility and social connection without infringing on the income limit for governmental benefit eligibility. Some strategies, like charging your child rent if he lives with you, might be beneficial to investigate, as it could reduce income if he's too close to that threshold. Many organizations, like Easterseals, offer classes specifically tailored to helping individuals build the skills needed to join the workforce. If working in the private sector is not the right path, try engaging him with household chores or with projects in the neighborhood. One of my friends has a child with autism, and she loves dogs. Every day she walks a dog in their neighborhood a couple of times throughout the day. There are also many options that don't include working for a paycheck. There are volunteer opportunities and social connection groups that can help create a sense of community and belonging. Easterseals also offers many of these groups, and there are numerous ways to get involved with other organizations in town if your child has a particular interest that you want to help advance.
That brings us to the end of our questions for this evening. Tasha and Sarah, thank you both for your support as members of the Easterseals Midwest Women's Giving Collective and supporters of the organization's mission. We appreciate you taking time out of your busy schedules to share your insight on something so critical as planning for your loved one's financial future. We also want to thank Easterseals CEO Wendy Sullivan and Senator Eric Schmidt for joining. Before we end tonight, as Tasha just mentioned, Easterseals Midwest offers a wide range of services for your child with a disability, no matter their age. To learn more about Easterseals Midwest, the Women's Giving Collective, or to contact any of our panel speakers, please visit Eastersealssummit.com. Tomorrow, you'll receive an email with a link to this recording, as well as contact information for Sarah and Tasha if you and your family would like to utilize their services. Finally, please remember that the information shared in this summit is for informational purposes only and is not intended to be personal financial advice. Please consult a financial advisor about you and your family's specific needs. And again, thank you for tuning in. Thank you to Edward Jones and Minetta for sponsoring this summit. We look forward to seeing you at our next one.